Yo, what's going on? My name is Chase. You're now tuning in to Chase, my YouTube channel, where showcases my life, the things I'm passionate about, and what Arkansas has to offer. If you haven't already, make sure you click that subscribe button so you can be a part of the Driver Squad. Make sure you like this video, because if you didn't know, once you like this video, you let everybody know on YouTube that this channel is valuable. Share this video with your friends and family members, and let them know Chase Way is popping. Let's get into today's video.
Nah, for real. I pull up no star for real. I hop in the whip and take off, you know I'm on my
Driver Squad, what's going on? Hey, I gotta show y'all something real quick, because this is about to be very informative, and I'm just gonna advise this. I might scale back. I know I said I'm gonna scale back, but when that gut feeling is telling you to do something, you gotta listen to your gut feeling. And I think I wanna listen to my gut feeling on this one, but let me put y'all on the screen. 3, 2, 1, let's go. So even though I'm not shying away from the stock market, but when you see somebody else analysis and breakdown on what's going on, you just have to pay attention and be aware. I know there's in the next August, around August coming up, it's about to reach low levels, and I kind of want to be ahead of the curve so don't nobody get burnt. So I'm just gonna play a little bit of this video, and we're gonna dive in deep. We're gonna dive deep in detail of what's going on. I don't know why I keep forgetting that cliche phrase. We're gonna dive further in details. Which one is it? We're gonna dive deeper in details, or we're gonna dive further in details? Y'all let me know down below.
Is a perfect storm brewing in the world stock markets at the moment. I go through an in-depth technical analysis of the S&P 500 index. We look at some other very important volatility indicators also, and as promised, I cover why the bond market historically has been a predictor of minor and major recessionary periods. Hello everyone, it's Sajad. I hope you're having a good weekend so far. So lots to get.
You got my subscribe button on that one.
The first thing I'm going to start on before we get into the S&P 500 is, as promised, a quick look at the bond market, so I can explain exactly what's going on, why people are talking about kind of yield curve flattening or inversions all the time, and why this is important with regards to what's going on right now. So let's have a look. So this is a weekly chart of the US 10-year yield. And basically what this is, in a nutshell, for example, when you take out a personal loan, let's say you wanted to buy a car or something like that, you pay a certain interest rate. What this is the interest rate the government will pay on a 10-year bond. So if you are lending the government, this is the way I think of it, if you're lending the government money for 10 years, so 10-year bond, you will get an interest rate of, well, it's around 0.7% at the moment, and that's down a lot historically, so it doesn't pay particularly well. But let's have a look at a 2-year bond, and a 2-year bond is currently paying 0.2%, so it's even worse. But we were seeing that yield climbing significantly up until kind of October 2018, and then it's dropped. But what's the point of all of this? What's the key here? So I've drawn here a small chart, and on the kind of left y-axis, what we've got is the different interest rates plotted here. So at any one point in time, for example right now, what you'll see is there's an interest rate for the 2-year, 10-year, 30-year, and there are even shorter term bonds. So you could get 1-month bond, 3-month bond, and even in between, so you can get a 5-year bond as well. And if you plot the interest rates, a normal healthy yield curve is where the higher or longer maturity bonds offer a better interest rate. That's normal. If you were lending somebody money for a longer period of time, let's say 10 years or 30 years to the US government, you'd expect a higher interest rate. Why would you expect that? Well, because you don't know what's going to happen in the economy in 10 or 30 years time. You're taking more of a risk. So it all comes back to risk and reward again. You're taking more of a risk, so you want to be paid better. You're taking less of a risk for a 2-year, because you could say, well, you know, I'm not expecting anything massive to happen.
I'm ready for him to say something important.
happen in the next 2 years, so they won't pay as good a rate. That's completely normal. Where things get twisted here is, let me delete that line there, where things get a little bit twisted is when the curve starts to flatten, like so. And this is where things get very, very concerning, because what we're seeing here now is we're getting the same interest rate for a lower maturity bond as compared to a longer term one. And what you could kind of deduce from this is that people are more concerned about the long-term health of the economy. That's why the yields have reduced, because it's all about supply and demand with this. So there's not a lot of interest in taking a 30-year kind of bond, taking that additional risk. And this becomes a big problem, because when this happens, when you get this flattening or even inversion, and what happens with inversion is this. So we delete that line again. When you get the exact opposite compared to what should be happening in a healthy economy and a healthy bond market. So what you're getting is the 10-year going lower than the 2-year in terms of interest. Now, let me show you an example of that. This chart I have here, this is the 10-year minus the 2-year. And what you see here in 2007 is you saw the number get below 0, which meant that the 10-year interest rate was lower than the 2-year interest rate. And what history shows is when this happens, it predicts a recession coming, usually within the next kind of 6 to 12, sometimes 18 months. And that's what happened here. That was preceding the great financial crisis, which again didn't happen for a few months, but then once it kicked off, it was very significant. What did we see here in August 2019? We saw the same thing happen again. We went negative, meaning people weren't as interested in these longer term bonds. And perhaps you can deduce from that they did not think in the next 10 to 15 years the economy was going to be as strong as expected. So even pre the pandemic, so in the middle of last year, the Fed got involved and they started buying bonds. And they were doing this because of this inversion. Now, what are we seeing in terms of the yield curve right now? So again, this is the 10 minus the 2-year. What we're seeing on a smaller time frame is after that inversion last year, we're struggling to get back to normal, so to speak. As I mentioned earlier this week, this is not going to tell you what the stock market is going to do tomorrow. This is just a longer term indicator to be aware of. What happened last year usually indicates that we're going to have a significant recession that usually lasts a couple of years. But what the stock market is telling us is, well, maybe we just had a bit of a dip for a few weeks and then that's it. That's not what the bond market is actually saying. So there's a bit of divergence there. And remember, nowadays, this is all artificial and heavily manipulated as well. So perhaps it's less relevant because the Fed are buying up all different kinds of bonds, and eventually they may engage in yield curve control, which is, again, in a nutshell, just messing around with this chart. Remember, they buy their own bonds, so they could potentially manipulate this back into a healthier looking curve. The problem there is a lot harder for them to influence this side. It's a lot easier for them to influence the short term. But anyway, I hope that's at the very least giving you a better idea. If you have any questions on that, just comment below. So let's get on to the
That was a very good background for sure.
Before we do any analysis here at all, I want to point something out. Just simple pattern recognition. One thing to be aware of here is, for example, in the move up in 2019, we saw quite small bodied candles as we were moving up. A couple of sharp selling days, but not that much. And even in the move up here from the March lows, we saw quite small bodied candles. Now this move down, and this is all in the US trading session, these moves, all not in futures, this is all in the trading session. One thing to note here is, as we moved up, a lot of the actual movement was happening not in the US trading sessions, as you can see by the small green candles. Apart from these recovery candles here, the rest have been actually quite small. So a lot of the movement up has been in the futures trading, so overnight trading, the Asia session, Europe session, etc. Just something to be aware of. The last time we saw a strong selling day like this in a US trading session was actually here. So the initial stages of the crash in February. Could it be a pullback? Sure. But there is a slowly increasing probability right now that this could be something significantly worse. The other thing I've been talking about earlier this week are the gaps as we went up. It's very common at the end of a move to have a big gap exhaustion gap. That's what we could have seen here, and an island reversal pattern.
And that's what I wanted to talk about. It's not looking too good. So I would say, what am I gonna do with the money that I have? Let's see. Let's look. So far, I'm up in a lot of companies. Some companies I am down. What is Chaseway going to do? What should I do? I think I'm going to probably, I don't know. I'm gonna be honest. I don't really know. My gut feeling is telling me to get out of it, but it happened to me once before, and I at least want to wait and to see what Friday do up until Friday, and then that's what's going to determine what should I do. But y'all go watch that video. Click the link in the bio. Y'all watch that video. Get some more insight. Get some more information on this video. Shout out to Sajay. You said your name. Matter of fact, I'm gonna go back.
Some other very important volatility indicators also, and as promised, I cover why the bond market historically has been a predictor of minor and major recessionary periods. Hello everyone, it's Sajad. I hope you're having
Sajad. Shout out to Sajad for this video. Everybody, y'all go check this video out, because I watched it once, but I know I wanted to make sure I brought it to y'all attention. I really can't expound on it or break it down like that, but at least I knew that I had to bring it to y'all, because since I talk about it, I want to make sure that y'all informed too. So y'all check that video out, and y'all leave y'all thoughts, comments, and concerns down below. My driving schedule been a little crazy, so it's gonna be a little weird, but what I am going to do, I'm gonna go back into the Cash App category apps, and I'm going to start putting out the dividend yield on a lot of companies that do share dividends. So that's what I'm gonna be talking about coming up. I'm not gonna be talking about no stocks or nothing like that, just only dividends. I'm not gonna be reviewing on what stocks, because I think I did enough videos on that so far. So we're gonna take a pause, and we're gonna stay focused on the dividends. I want to give a shout out to Derek Carr. I want to make sure I put his name and all the information that he showed on the screen. Where are you? Where are you? Where are you? Here we go. 3, 2, 1, let's go. So shout out to Derek Carr, and I guess this is all the companies that he invested in. I'm not 100% sure, but this is what he invested in so far. So shout out to you. I said I was gonna put this on the screen for you, and thank you for sharing all the stocks that you're investing in. So y'all see that? Y'all can look at these companies and see how they performing. And yeah, man, I'm up out of here. I gotta go deliver to this Walmart so they can get their goods. So I'm wondering, this is what's be going on when y'all sleep. Truck drivers like me be having to wait until Walmart open up. Y'all have a great day. Chaseway is out. Peace.